Good afternoon, everyone. Welcome to this TradeStation webinar. It's great to see everyone connecting today. So thank you for taking time out of your schedules to be here and learn a little bit about options trading and TradeStation in general. As you can see, I'm joined by my colleague, Brandon Wendell. He is a trader and an educator by nature, and we're just very happy to have him here today. But before I pass the floor over to him, let me just go through some disclosures and some announcements and some places that you need to go to in order to explore. All right, this is our title slide. It's Options Replay, Strategizing Your Options Trades. It's a great webinar because we are going to take a look at the markets, not only what's happening today, but what happened last week, and see if there's any option strategies that may have worked, and if there are any strategies that were put into place, the reasons why they worked and they didn't work. So we always take a look at both sides of the trade and making sure we always provide a balanced view in terms of trading options. For every symbol that we mentioned today, just keep in mind that these are not recommendations of TradeStation. Also, that active trading is not suitable for everyone, and that past historical performance is no guarantee of future results. Also, keep in mind that even though it's a pleasure to have Brandon here with us, he's not affiliated with TradeStation, but we are going to benefit from his experience and the way that he's going to present the content to us. All right. Nothing else to do, nothing else to say. So, Brandon, I'm just going to pass the floor over to you. Thank you for being here with us. And I'm just going to mute my microphone and let you do your thing. Okay.
All right, sounds good. Thank you, Jesus. Appreciate being here. Let me go ahead and let's see, share my desktop. And welcome, everyone. Welcome back. My name is Brandon Wendell. For those of you who may not be aware, I've been involved in the markets since 1996. It's been quite a while. And I got involved originally as a retail broker, so a Series 7 and 63 and all that good stuff. Ended up trading for a while. Actually, I was a retail broker, moved into back office operations first. And with the back office operations, I actually became a trader for the brokerage. So I was basically making what they call an agency desk operator. So I was trading for the customers, basically getting the orders filled and also institutional orders filled for the brokerage. Did that for a little while and then moved on, became a private hedge fund trader for a little while. And honestly, between the back office operations and working for a hedge fund, I gained a lot of knowledge about how professionals trade the markets in a way that is completely different than the way that you and I might approach the markets from an individual retail level. And I try to bring that to my workshops that I do, both with TradeStation and on my own, to enlighten everybody and teach them how the markets truly work. So I'm hopefully going to share some of the information with you today, as well as in future sessions. I'm also a charter market technician, so I've done a lot of the schoolwork. I've got a master's degree in technical analysis, and yeah, that's about it about me. If anybody has any questions, let me know. If you have any questions about what we've gone over in previous sessions or questions about trading options in TradeStation, we're going to be looking at TradeStation. Where is it here? Option Station Pro, and utilizing that and some of the capabilities that program has. It's a very strong program, a lot of good features inside of that program. Bear with me one moment. Just making sure I save my work before I move on. That's all. So again, if anybody has any questions for me or any questions about TradeStation or about options trading in general, please let me know. Be more than happy to answer those questions for you if I can. If I don't know the answer, I'll try to make it up or probably ask Jesus because he'll know more than me. Anyway, you can see on my screen right now, I was looking at QQQ and put on a couple different option strategies for a bearish potential position. I do have other strategies already in place as well. This is a simulated mode. I forgot to close out one, which is nat gas. It expired already. That's okay. I think the crude oil as well. But the reason why, first of all, let me go through some of the rationale and then I'll go through some of the trades and the results. They're not done, by the way. There is still time left until the expiration and price movement that I'm waiting on as well. So dropping over to TradeStation, where when I'm trading options, I typically start off, I take it in three main steps. I've mentioned this before in previous sessions. Number one, are you bullish, bearish, or neutral on the underlying? So I start off obviously looking at a chart if I'm trying to determine whether or not I'm bullish, bearish, or neutral on the underlying security. And that's going to give me an idea of which strategies I might start looking for. And the nice thing is, for instance, I'm looking at QQQ for right now. In TradeStation, there's some tools. Once we get to next steps, if I go to manage, I'm sorry, not manage, search, I can actually type in the security I'm looking to trade. and choose my view of that particular market. So if I'm bullish, as you can see, I can do bullish limited risk. Actually, let me see. Before I go any further, get an extra teaching tool open for us. Let's see, did I do this? There it is. Perfect. So again, if I go in, I have choices here. So I can go bullish with limited risk or bullish unlimited risk. Bearish, same thing. Active market, should have gone back here first. And there's limited risk for that. And quiet market, limited and unlimited risk. So the difference is obviously bullish, we're expecting prices to go up. Bearish, going down. Active means that we're expecting possibly some big price movements in that market. We're expecting volatility to rise. And there are certain strategies that we put on for a potential rise in volatility. Or a quiet market would be the opposite. We're expecting the volatility to decline, and we want to take advantage of the drop in volatility. But it all starts to stem from the first step. Do we care, or do we think the markets are going to go up, down, or sideways? So that's step one. Step two, so let me edit this down there. So step two, are options cheap or expensive? Well, what the heck does that mean? I mentioned volatility. Volatility is probably one of the bigger influences on options pricing compared to some of the others that are out there. And I've mentioned it before in previous sessions. I'll mention it again, I'm sure, in the future. But when you look at an options chain, for instance, and I'll just pick the Qs in a random date here, we have things we can look at, and I can customize the columns as well to be able to look at certain things. I'll be adding in delta, gamma, theta, and vega. Probably skip rho. We don't look at that all too often. I'll also get rid of these other two just so we can focus on what we call the Greeks. The Greeks are risk parameters, and they give us an idea of how the option premium will typically react to certain stimuli. And those stimuli are the risk we have in the markets. And they're pretty simple. D delta direction. It is based on the direction of the underlying security. How will that influence our premium? If you have a positive delta, it means that you would typically gain that much for every $1 move of the underlying security. On a negative delta, it should move opposite. So basically, if you have a negative delta, you're expecting the prices of the option to go up when the underlying security goes down, and vice versa. So they move in opposite directions of each other. Okay. We have gamma. I don't know if I have an easy way to remember, but it is an acceleration factor for delta. Basically, how fast delta is going to change. And it is somewhat important depending on what options you're trading. Same thing with delta. But we can also go delta and gamma neutral as well. If we don't care which direction the market moves, remember, our choices were bullish, bearish, or neutral. We want to be neutral in the market. We can neutralize delta and gamma, and I mentioned this before, by trading multiple options. We call that a spread. You can take some positive and delta and gamma and neutralize it with negative delta and gamma. And therefore, you get close to zero. For instance, here you can see that we have 0.59 positive delta, and we can match it up possibly with a negative 0.46, or let's go even higher, maybe negative 0.55. If you were to trade those two options together, it's buying both, you can see our delta now is it's actually 3.76 because it's showing multiplied by 100. So it's actually 0.0376. Okay, again, it's positive 59 minus the negative 55, and that's the difference right there. It's not adjusting in real time, though. So that's one thing that we have. The delta we deal with for direction. Theta, T, that's time. So that is time decay. And of course, we have negative theta when you buy options because time is a wasting thing when it comes to your options. They start melting in value and they decay by that theta amount. If you sell options, though, that's a positive because you want the value to drop. That way you could buy back cheaper if necessary. So theta, T for time. But most importantly, you want to focus a bit on this vega, volatility. Okay, V for volatility. And you can see right now we've got 84 on this 530 strike, which has about 59 days left. Now, if I take that same strike, but a different date, all the Greeks the big one that's going to be different is the vega. All the Greeks will differ a little bit. Sorry, I was looking at what, 530? So this 530 had 84 Vega, and about 59 delta, 17, negative 17 theta. You take a look at the 530 here, 0.66, so a bit bigger on the delta. Gamma went from, was it 0.09? 0.09. Yeah, 0.009 all the way up to 0.033. So that gained a lot. Theta also gained. It was what, 0.22? It went up to 5.4, and the Vega dropped. So while we had big gains in delta, gamma, and theta, Vega went the opposite direction. What that also tells us is, depending on the type of option you're trading, the more time you have left until the option expires, the more you are at risk to volatility. But you have less risk on theta, gamma, and delta. So depending on how much time is left until your option expires, that changes your focus for your risks and your potential losses. Now, you can lose from any of those, but the effect is going to be greater, especially if you go out even further. This had 59 days left. Let's say we go out to 180 days left, roughly. That 530 has 1.47 Vega. That's a huge change to the upside on the volatility. We didn't change too much on the delta, did we? We're at 0.59 and we're now at 0.61. Not a big deal. We were at 0.009, we dropped to 0.005. Again, didn't change much. Even the time value, it's 0.12. We're at 0.17, not a big change. But the time really affected the volatility exposure. The longer term options have much more risk of volatility movements than the other option Greeks do. So that's something I'm going to take into consideration. And the reason why I brought that all up and talked about volatility is when volatility is high, options are going to be relatively expensive. That typically means you want to be a seller of options, especially if there's much more time left until expiration. If there's very little time left, then you're not going to have as much volatility exposure. You may not have to worry about that as much. And the options may not be as high priced. Now, again, it depends on the individual implied volatility of the security you're trading, because you still could have very high implied volatility and high price options, even with very little time left. But overall, typically, when I'm looking at a security, I'm looking to see am I bullish, bearish, or neutral. And I'm also looking at the implied volatility. Did I bring that up? Just to see how it is now compared to where it has been before. So on TradeStation, I'm going to use the implied volatility, all options, add that in as a study. And let's expand this. You can see that our implied volatility right now is collapsed. It's gone down quite a bit. Another way of measuring the volatility on my chart, as you can see, I've got the Bollinger Bands. I usually don't try to put too many indicators on my chart. A lot of them are duplicating each other anyway, but you got to understand what exactly are they measuring. And the Bollinger Bands are measuring volatility. Technically, they're measuring 2 standard deviations of price over 20 periods. Well, depends on what you set it at. I believe the default, didn't go there. There we go. The default is 20 periods on TradeStation with 2 standard deviations of price. So it's measuring standard deviations of price. Basically, 2 standard deviations should contain roughly 96% of all price. Samples, I should say. Now, it doesn't mean that we can't go outside the bands. Of course we can. But the likelihood of staying outside the band is very low. Of course, the bands move. And they're centered on this moving average, which kind of helps me with the trend as well. So when the bands expand, volatility is getting higher, typically. When the bands contract, volatility is dropping, okay? So you got to be careful too, because this is also a little bit lagging with the bands because it is measuring previous price action, okay? So it's measuring the previous closes and the distribution of that price. Meanwhile, implied volatility, hence the name, I mean, from the name implied, is suggesting what the volatility is going to be going forward. Basically, implied volatility is telling you the expected price movement of that security within the next window of about 30 days, depending on how you have the indicator set. It's typically looking at the next 30 days. So currently on the Qs, I have relatively low implied volatility, and I'll bring that back in a moment. I'm going to go back to my note here. If I can find it again, there we go. And step 3, because we have we bullish or bearish or neutral, our options cheap or expensive, numero tres, choose the right strategy. Seems pretty simple, and it's not always that simple. But again, depending on which way the prices are expected to go, we can take a bullish strategy, a bearish strategy, or a non-directional strategy. We're neutral. If options are cheap, I typically want to buy those options, especially if I'm expecting them to go more expensive or become more expensive, excuse me, with an increase in volatility or an increase or decrease in price. Notice I said a decrease in price that can raise the value of put options. The thing about options trading is we have a lot more dimensions to think about than a typical stock trader or even a futures trader, right? With futures or stocks, it's pretty much, is it going up? Is it going down? You buy or sell. With options, you could buy and be bearish. You typically don't do that in stocks unless you're buying an inverse ETF, right? So we have that extra dimension, as I mentioned. And again, if I go back to OptionStation Pro in the search, we can choose bullish, bearish, active, quiet, or individual strategies we're looking for as well. So let's say if I was bullish, but I want limited risk. Yeah, I could put in either, basically, it looks like it's sell put vertical. That'd be a bull put spread. Buy call vertical, which is a bull call spread. Buy a call, single leg. You can see what is the projected asset price movement, where you're expecting it to go, up or down. It shows in percentages, but it's very nice that it actually will go ahead and show you the price next to it as well. When are you expecting this to close? How long are you expecting to be in this particular position? So I'll actually do an example in a little bit. And volatility. Are you expecting a volatility change? Because again, that's going to affect price in the future. You can filter out certain strategies, and then, I don't know why it's cut off here. Oh, there we go. Just got to click over to it. But you can actually search by different features. And let's just run the search for now with this. So it'll come up with these examples. Looks like it started off altogether with single leg strategies. And let's put it at, there we go. So we'll say projected profit. Let's see which one's going to give us the most profit. You can actually search by these features. So the projected profit, the biggest one would be a single, looks like a call, 501, 31st July 501 call. Now, it costs $40. Max loss is being shown as 4,057. I think that must be doing, yeah, times 100, obviously. It's one contract. So the max profit is obviously infinite. However, based on the price movement I'm expecting, it shows you the potential profit of $1,546. Probability of profit, though, is only 47%. Not as good. Maybe we go by probability of profit and do searches. Unfortunately, it's not really giving me a whole lot of great examples here. Maybe I wasn't at the top. There we go. Let's go better, hopefully. For some reason, it's not giving me spreads. I'm not sure why. And not include something, let me just check. Let's say the volatility goes up a little bit here. Like I said, we can go back and take a look at an actual example. It's odd. I'm not getting spreads. I must have had something set wrong. No, should be good.
I think it's a number of results on the right. It limits
Maybe. I'm showing 100. I can try it less.
And that's the maximum. You may have to remove the buy call under strategy.
Yeah.
The spreads.
We buy include sell. Where'd you see the buy call?
Actually, I thought you could.
Can't remove these.
Yeah, you can't modify those, right?
No. Because usually I get spreads put in there too. And I'm a little surprised I'm not. We go out further here and see. It's really weird. I don't know why it's just doing single legs. Who calls, puts, buy, sell. And there it's going vertical with sells. And it should do the buys, though. I don't know why not. Very strange. I don't know. Normally, it gives me spreads as well. Like you said, I saw when I did the sell, it was giving me the bull call spreads. But I don't know why it's acting a little weird today. Anyway, even if we don't have this running the way I want it, I can still do my analysis anyway myself, which honestly, I usually do a lot of my own. Getting back here, are we bullish, bearish, or neutral? Are options cheap or expensive? How do we figure that out on our chart? Obviously, we can go ahead and put in those inputs and get some of the scans done for us, but we still need to do the work and figure out what's going on here. What are our answers? And what I did, I was looking at the cues. As a matter of fact, let me bring up my file here. There it is. Got too many monitors. I didn't know where it was going to pop up. Anyway, I was doing my analysis a little while back, and options replay file, trades, and my cues. There we go. And I'm sorting by date. There we go. So I was looking at the cues on June 13th as my analysis here. And basically, I could probably use the current chart too to give you an idea of what I was looking at. But overall, prices have been going up, and I noticed the bands were getting tighter. Again, I can go to the live chart right now, see the same thing as we go forward here. See the bands getting tighter, and they started expanding very slightly, but not by much. And as you can see, volatility was dropping. Let me zoom in a little bit more. June 13th. Oh, I thought it was before that, actually. When did I put on the position? Oh, no, it was much before that. I'm sorry. In the Qs, I don't know why it did that one. Because it did by date in the last one. It was June 5th. My apologies here. There it is. June 5th. There's my analysis I was doing for that day. So on June 5th, as you can see, volatility was dropping, and it was also well below the average. It had touched the average and started dropping away from that. Again, zoom in a little bit, show you what I was talking about. So I saw volatility was dropping. It was very low, which means if it's very low, it'll eventually go back to the average, because that's what happens. We go below the average. Now, unfortunately, sometimes the average just comes down and volatility meets up with it. Sometimes volatility will go up to meet up with the average. And there's a difference. Remember, if volatility is low, we typically want to buy options. And when volatility rises to meet the average, the value of options will go up. That means if you had bought options, their value will go up as well. Now, I'm not talking about direction or anything else yet, just the volatility. So looking at our chart here, there we go, and zooming in, it wasn't that much below, but I'm anticipating the volatility should try to rise from there. And before I even get there, direction. What was happening with the Qs at this time? I was expecting the Qs to return back towards this orange line, which is a particular moving average I use quite a bit. I actually have an entire strategy built off of a couple moving averages, and not the crossings of them because it's going to be too late. You got to be careful with your indicators. Most technical indicators are based on past prices or closing prices, which means they're all lagging. So if you try to buy the crossover of any moving averages, you're going to be buying way after prices have moved off the lows. But the thing to know about averages is that prices will move away, and there's what's called reversion to the mean. So when prices move away from the average, they typically snap back. And in a trend, they'll move away, snap back, move away, snap back. Okay. Just like the bands, though, sometimes the prices don't snap back much. The average actually curves to meet the price as well. And that's where you can end up getting losses because you anticipated the actual value moving. Instead, the average kept moving and still met up. For instance, here, we moved away from the average, snapped back. Didn't quite touch the average, moved away, snapped partially back, moved away, snapped back. Okay. Great question. Would I also not check to see that the ratio of implied volatility and historic volatility is less than 1 to determine? That's another tool that's available on TradeStation. Yes, I do use that on occasion as well. I'm looking to see where implied volatility is compared to historical implied volatility, but you can, yes, check to see where it is compared to historical volatility. Problem with that is historical volatility is just simply what you're seeing on the chart. It's the past price movement. So if implied volatility is very low compared to the previous price movement, it could be that volatility is just dropping. It doesn't necessarily mean it's going to come back to historic. It could go back to the average of implied, if that makes sense. But yes, you can still check that. And yes, if the implied volatility is relatively low compared to historic, it should actually be lower price options typically, but not always guaranteed. And where's it here? It is right there, implied volatility, historic volatility. And not only could you look at it here, and by the way, in June, I was expecting it to rise, and you can see the implied volatility started to rise because implied volatility is low even compared to the average. Now, it wasn't as low as back here in May, but it was in the midpoint and rising. I was going to say another way you could find securities that have relatively low implied volatility compared to historic is using a radar screen. So let me go ahead and bring one of those up. And where are you? There it is. And inside the radar screen, you don't have to try to pick out securities yourself to find which ones have low and high. There's actually what are called hot lists that you could use. So right here, if I go to data, add new page, hot lists, get to leverage some of the power that TradeStation has to help you find opportunities. Now, before we go any further, I'm going to go ahead and edit this page and make the font something we can actually read. There we go. I might as well make it bold too. That's a little better. So I have percentage gainers. I don't really care about that, but what I can do now with the activity here in the list, I can go to volatility lists, and again, microscopic print, so I can enlarge. But we have implied volatility. We've got SV/IV ratio, highest, lowest. If we want very high implied volatility, this is the other way around. SV, just so you know, is statistical volatility. Statistical volatility is the same as historic volatility. It's showing you the previous price action volatility, what's happened on the chart in the past. IV is implied. That's looking forward. So basically, we can look to see if implied volatility is very high and the SV is very low, we should have a very low ratio. That would mean options are expensive. This one that says SV/IV ratio highest, that would mean that historic or statistical volatility is very high, but implied volatility is low and options should be relatively cheap. So we'll choose that one. Go in, SV/IV ratio. It should show me right here. There it is. There's a number. So this shows very high statistical historic volatility, very low implied volatility. And let's see, it should be on daily. We're dealing with options anyway. Not that this matters. It still shows me daily information anyway. I believe, I'm not sure if we can do it here. Usually if you right click on something and hit help, it should give me the help on that particular indicator or whatever it is I'm looking at. Let's see if that worked. No? If not, you can actually just go to the help tab and then look it up as well. But it'll give you information as to what it's actually measuring if you need it as well. Now, I don't want to trade very cheap securities. I try to avoid securities that trade under $15 to $20 just because I want to avoid a lot of manipulation. When you start getting into penny stocks or even lower price securities, it's very easy to somebody come in with a relatively moderate amount of money and manipulate price. So we can actually filter for that. Right here, I can say, okay, my last price is greater than, say $20. There we go. We narrowed the list down to 17. Well, UNH is a pretty big name, $300 a share. The ratio, 1.13. It's one of the lower ones. We could possibly look at some of the others. This is crazy. This TXNM. Let's see. I didn't set the screen up very well, but let's see. Is this linked? There we go. TXNM. Just had a big gap and it's not really moving much after. It's kind of died off. So the volatility is probably gone by now. Anyway, let's take a look at the next one, FL. And let me change this around a little bit. I forgot I had a radar screen open already. And close that for now. There we go. Okay. IEI showing 2.83, but it doesn't seem to have extreme high volatility right now as everything's gotten quiet. It's odd for that filter to be showing me that, but it is. Again, I can check to see how are we doing. Implied volatility, historic. The company's getting bought by somebody else. That's a takeover candidate. That's why it's gone flat. It probably gapped wherever the buyout price is and just stopped there. Anyway, you can see right here, this is showing the opposite. Keep that in mind. Remember, this is SV divided by IV. This is IV divided by SV. So we see this is extremely low implied volatility currently versus historic. And let's see if it's low compared to previous implied volatility. Go to implied volatility, all options, and look at that. It is low compared to the average as well. So these should, in theory, be cheap options. Do I use IV stochastic? I have not. I can also, again, look at a few other things. If I go back over to OptionStation Pro, it was IEI, right? Yeah. Looking at IEI, let's say we go out, no, let's do 30 days. An extra tool that we can look at in the columns for OptionStation Pro would be theoretical value. Now, there's no guarantee this is going to be exact, but based on the Black-Scholes method, which I think is what they use for calculation, this tells us what the value of the option should be currently, and you can compare that to where it's actually trading. So if the theoretical value of the 118 calls are 419 and we could buy them for 60 cents, that is a cheap option. Okay, obviously. And it should be relatively inexpensive right now because of the low implied volatility compared to what we've seen in the past. Again, it's low IV versus high historic volatility, and even in comparison to previous. The puts, however, not so mispriced. I'm wondering if that's just an error up there. It adjusted. Okay, it took a minute. That's better. I was going to say that didn't seem right. It was way off. But even still, look at this, 60 cents. Obviously, we could try to get a better price between the bid-ask spread, but this still at retail value is trading 7 cents below its a theoretical value. That's almost a 10%. It is a 10% discount, isn't it? You could buy that for 10% off. That's what you want to do, is buy cheap options. Even on the calls, the put side, it's not as good. You can see 67 cents. Oh no, it changed. Never mind. Same thing. We could buy it for 60. It's worth 67 cents, and it's going between 65 and 95. This also may be a little off because it's after hours. When the markets are open for regular trading hours, you might see a little bit different pricing on the bid-ask spread, depending on how active the options are. But my point is, we want to look for cheap options. When implied volatility is relatively low, you'll typically find those. So on June 5th, what I was looking at was a couple things. I saw that implied volatility is relatively low compared to the average and compared to historic volatility. We were in a bit of a bullish trend, and I mentioned the moving average because I was expecting prices to snap back towards that average. We had gone up for quite a bit and extended away. We hadn't even had a small pullback like this in about 2 weeks. You can see we had that move away from the average, tried to snap back, moved away from the average. I'm expecting a snapback. We also are approaching a daily supply on the Qs at about 336 to 540. I said supply is not the same thing as support and resistance. Okay. So I use something a little bit different than support and resistance. You've heard me say this before. I look at basically institutional orders, and they leave footprints in the markets. I'm not going to go into all the detail at this point, but I'll do that maybe in another session when I have more time. But basically, I use what's called supply and demand, and I look for certain patterns in price that indicate there might be some leftover institutional orders. Given that I used to be one of those institutions myself, I see what they call working the order does to a chart. Basically, when you're trading millions and millions of shares of stock, you can't buy everything all at once. You break up your order into smaller pieces and you do what's called working the order. And by working the order, you actually leave a mark where you trade. So if you can see where these institutions are trading, you piggyback on them. So this was the imbalance origin of supply, where there's a lot of supply and not much demand, and prices were pushed down. We're approaching that area. Now, you'll notice I use RSI for this as well. With the RSI, I'm not looking at this as an overbought, oversold. Okay, typically, when things become overbought, a lot of people think, oh, it's going to drop. Not necessarily. In a strong bullish trend, overbought becomes more overbought. Oversold in a strong downtrend becomes more oversold. So what I'm looking for is a lack of momentum supporting the trend. And we call that divergence. And you see it a lot. It doesn't necessarily only happen on RSI, it happens on other indicators as well. You can see that prices were making new highs as we're approaching that selling pressure origin, but we lost momentum. And we can see it now. That was the picture I took back in early June when I started this trade. And even currently, if I bring back the right chart, there we go. Let me get rid of some of this stuff. Got too much going on. There we are. And then we'll zoom in a little bit. And you can see prices are rising. Momentum is not. Basically, when you're above 50 on the RSI, that's measuring bullish momentum. When you're below 50, it's measuring bearish momentum. Look at what happened here. Prices were moving to the upside, but momentum was not gaining. You typically do not make new highs unless you have extra momentum, or at least the same momentum you had before. That's a divergence, and that is usually preceding a drop in price, especially if you're approaching this wall of imbalance with lots of selling pressure, which is what we're approaching. So I'm anticipating a potential move down in the markets, especially in the Qs here, when I put on that trade. Okay, let's see, where did I go there? Yeah, I missed it a little bit, but this close. And you see what's happening. We're coming up to that area, and we started stumbling away. Didn't quite get back to my average yet. As a matter of fact, let me see. Move this out of the way. There's studies. Add. Exponential. There we go. Forgot the prompt for editing, of course. And let me get rid of the Bollinger Bands for now, so I don't need them. Change the color, the thickness, and the inputs. I use the Fibonacci number 89 moving average. And you can see we have not been snapping back to that average in quite a while. But when you start looking back, you'll see that this is a sideways trend. Here we're in a bullish trend. We come back and bounce off that average. Now, it took a little while, but eventually snaps back. Even when you go into bearish territory, you usually snap back towards that average. And over time, you'll actually see that price does respect that average over and over again. There it is, touching it again after it had been away. Even when we're moving a bit sideways, we try to hover right around that average. There we snapped, moved away, snapped back, and changed trend. Not only did we change trend there, we even gave a warning sign before it did it, trying to make lows without the momentum, divergence. No, I don't use the Chaikin. I just use the RSI. I found it works really well for me. I modify it slightly. I've used it for many years, and I really enjoy it. I like the RSI, the way it works for me. I started using it when I started studying for my CMT, but like I said, I don't use the traditional RSI, and I don't use it for overbought, oversold. Why is there no chart at the money price of each option? Could tell where the option price is, low or high with indicators. I don't know why. You don't really chart the option premium. You can actually chart the option premium on TradeStation if you wanted to. I'm not sure if the indicators really tell you what you need to know quite as well as what price does. That's really where you want to focus mostly, is on price anyway. But yes, you actually could chart the option itself and use the indicators on it. I just don't know how accurate it would be for anything. So if somebody's asking, why is there no chart at the money for price for each option? There is. You could chart it, but I really don't usually go there. So anyway, I saw this divergence. I was actually becoming more bearish on the Nasdaq and therefore the Qs, expecting them to drop back down towards that midpoint, not the midpoint, sorry, that 89 exponential moving average, partially because we have that indicator saying we're losing momentum right now. Oh, there's not, there needs to be? Okay. Might be able to do it with easy language, perhaps. I don't know. Let's see, remove trend line. There we go. Going back, where was I here? To my charts and pictures and all that good stuff. First thing I did was I decided to do a couple different strategies. The easiest one, if you're bearish on a security, is simply buy a put. Now, obviously, the advantage to buying a put for a bearish security is it's simple. You go out and you buy a put. Now, you'll notice I bought September 19. Why did I go so far out? They're very pricey. The reason why I went so far out is, for one, I don't have to worry about time value. Okay, I'm taking time out of the equation, especially when you're only doing one option and you're buying. Now, if I go back to the Q options, let's see, which one did I buy here? 525 put. So looking at the 525 put, is it loading? Nope. There we go. For instance, right here, I have July 18th, 2025, and the 525 put has a theta of 16 cents. It'll lose every single day. First of all, I don't know if 31 days is long enough for me to achieve my goal. Looking at, wrong chart. There it is. Looking at the Qs, again, I was entering this around June 5th, and just looking at this particular move, you can even, I should have done that. Should have kept it where it was. Looking at this, it's very similar to the move we had here. And the move we had here, you see, this is a snapback. It didn't quite get to the moving average, but it did drop quite a bit. Let's see, when I say quite a bit, I guess I can measure percentage-wise, but I was just trying to get the scale off to the side here. We were going from roughly 516 down to about 496. So a good 30 points in the NASDAQ. So actually it might be closer to this and that drop, sorry. Yeah, and let me do this so we can see it next to each other. It'd make it much easier to compare. Come on, is it gonna work? The snipping tool doesn't want to work. There we go. Just try and take a picture of that and then hold it. Just compare it. There. My mouse keeps jumping. I apologize. There we go. And you can see, not exactly the same, but very similar conditions. And I should have taken a picture of the RSI as well with the divergence. So I'm expecting a pullback at least to about 510 to 505 on the downside. Now, when will that happen? It could take a couple more weeks. So I don't want to deal with that time value. So I decided to go way out to September just to give it plenty of time, especially during summer doldrums. We typically go a bit sideways in the NASDAQ especially. So one of the strategies I did was the put. You'll see I also did a bear put spread, in this case choosing 525 and 500, buying the 525, selling the 500. Instead of just buying the put, now I've reduced my cost, obviously. The initial buying the put cost was $20.36 for the 525 put. the spread dropped that down from 20 down to 736. So it dramatically dropped the price. What did I give up for that? Remember, I'm expecting the price to bounce at around 505. So it doesn't really mean I'm giving up anything. If the price continues beyond 500 to the downside, then I would not be able to gain any more profit beyond 500 by doing the spread. So right now, my max profit, which I'm probably not going to get that max profit anyway. Remember, I'm expecting to bounce before 500. That would be 1764. And I spent $736 to open that position. That's actually a max loss as well. Meanwhile, it's not realistic, but for the put, yeah, is this the picture? Yeah. The max profit would be if it goes to zero. That's not going to happen. The Qs go to zero. But the max loss is $2,000. So I've reduced my risk from $2,000 down to $700, and I didn't really sacrifice much of profit because, again, my anticipation is that prices are only going to drop down to about that average. Notice the average is sloping up. It'll meet up around 505. Okay. I reduced my costs and controlled it a little bit more when it comes to the position. The other thing you'll see, let me close this one out and close another one out. There it is. Notice my theta has also dropped. Okay, I've only got 52 cents of theta to worry about per day, again, because I chose September. And my delta has also dropped dramatically. So I won't gain as much for every individual point that we move, but I'm also reducing our risk when prices go against me. If we take a look at where we are currently and just compare those two positions, there is the bear put spread right there. And I should have kept that open. There we go. The bear put spread, and there's the put. The single put is down $377 currently. The spread is only down $127. I've reduced my risk by $250 right now by doing a spread over doing the individual option. I also reduced my cost of carry quite a bit from, was it 2033 down to 747. So that was a good opportunity to protect myself. I didn't really give up much on the upside potential because, again, if prices end up moving to my target, yeah, I might not make quite as much because of the delta, but I am still going to make a decent profit. And rate of return wise, it might end up working out better. I'm not sure if I did the analysis picture or not. Let me take a look. I think I might have forgotten to do that. Yeah, I did. I did a couple other positions. Again, there's multiple bearish positions I could take. Another one I did was a bear call spread, which is I sold the 530, bought the 535, so it's only a 5-point spread, expecting prices to stay below $530. And obviously, it's not going the way I expected to yet, but there's still plenty of time. With this, my max profit, $287, basically the premium I collected when I opened up the position. My max loss is the difference between the strikes minus the premium I collected. So I had a pretty good ratio, about a little over 1-to-1 reward to risk. Okay. How's that doing in comparison? Again, I'm not worried about this yet because the price, it's got a lot of time left. This is not a quick intraday trade. I'm looking at this for a little bit longer term. Here is the call spread, bear call spread. That's only down $39 right now. Current price right now is what, 534? So it is in the money, not all the way at maximum loss. But of course, again, I've got time decay on my side and I've got time left until this expires way out, again, until September. And finally, the last trade opportunity I did, again, to reduce risk as well. And I want to compare these, and we're going to keep going back to these in the future. I'm just kind of setting up everything right now to show you how my thought process is. And when we get to the point where I'll just go ahead and look for one, a bullish one as well. We can start tracking that and following along with this to see how they go. But the other strategy was Iron Condor. And the Iron Condor, once again, I was expecting prices to start dropping between 530. At the time when I put on the trade, it was at 527. And my target is around 505. I didn't expect the prices to go below that. So I put on the bear call spread and the bull put spread at the same time. Okay. Oh, yes, this is recorded. Absolutely. I'll show you where you can find it in just a moment. So I'm selling premium, expecting the time decay. Notice I don't have much directional exposure at all. I took away almost all of the directional exposure. My delta is almost zero. So it doesn't really matter if prices go up or down. What matters is time goes by and these options become less and less expensive. And it stays between the two options that I sold. We'll see what happens. Oh, there you go. Jesus got you the link. It's in the Options Education Center. You can see that there's the videos are available there. So I had the time decay working for me. Notice this, max loss is only 111. My max profit is much better than my max loss in this case. And as of right now, I think I'm only down $25 in that one. Yep, $25.50. So that one's taking the least amount of heat because I actually have a neutral strategy. So I just wanted to compare a debit single leg, a debit spread to reduce risk, and directional. We're still directional, bearish, excuse me. We have a credit spread, which is bearish, and we have the iron condor, which is a neutral strategy, also a credit strategy, trying to take advantage of this. I also did the longs, the bearish long debit strategies because I wanted to show you the difference in volatility changes. We haven't had too much of a volatility change because the position was just put on the 5th of June. But when we get together in a couple of weeks for our next session, we're going to be able to see as time goes by, how the volatility affects it, how the time decay affects it, and how the price will be affecting these types of positions. Okay. So let's see. I think I answered most of the questions for the most part. Eller smoother would be better than a moving average. Even with the Eller smooth, you're based on current prices. You can't do anything but project forward on current prices. There's no forward-looking technical indicator, period. There's nothing that exists that looks forward or projects forward price. Everything is always based on past price. You could try to project based on volatility going forward where you think things are going to be, but really the only thing that I've ever found that kind of really predicts what's going to happen in the future is price itself. And I've had to study most of these indicators as part of my CMT program. So I see what a lot of them are built. There might be less delay, yes, but for my purposes, the 89 moving average works pretty well. Again, I'm not buying at it. I'm using it as a little bit of a guide. Yeah, I don't really even use it too much for the trend. I use more of the RSI as an opportunity to identify strength of trend. And there's certain things that it does that allow me to identify which trend we're in as well as how strong that trend is. I can do a very similar thing with the CCI, the Commodity Channel Index. I used to use that quite a bit as well. So unfortunately, I've run out of time for today. Have I ever put on an ST iron condor theta decay and a long-term iron condor? I'm talking about doing kind of the opposite of each, a short iron condor and a long iron condor, or short term. Oh, doing the same strikes with just different time frames. I don't know what the point would be of the longer term. The shorter term would give you more time decay, which is part of the reason why you put it on. The only advantage of the longer term would be obviously the volatility. Long term will protect the short term. In what way? Just because you have more time left? I don't understand how it would really protect it. I have to look more into that. Because if you're selling the same options, just the only difference is time. It doesn't really, I don't see how it protects it. I'm sorry, was I a short term 2 to 3 days? Well, 2 to 3 days until expiration on an iron condor, you're not going to be getting a whole lot of premium either, though, unless you do something really close to at the money. You know, for instance, right now the Qs, where are we here? 535. If I do 3 days away, let's see, I'll do, I don't know, 538. Try to pin it. You mean I can leg in and try to pin it? I don't know. I'd have to talk a little bit more about that. And unfortunately, I don't have time right at this moment to do it. Let's see, what did I do? 538 and 540. So 2 points, 530 and 528. So yeah, that's something, but we can definitely take this offline and talk about next session. What you can do is you can email us education@tradestation.com and specifically mention something about options replay. Write in your email what you want to talk about. I'd be more than happy to take a look at it and talk about it in the next session, a little bit more in detail. Absolutely.
For sure. Yes. Thank you, Brandon. And I'm going to take this opportunity to thank everyone. Thank you for attending this webinar. Please remember the Options Education Center is available for everyone to explore. I'm just going to share very quickly where items are located. But if you go to TradeStation.com, I'm not sure if you showed this, Brandon, but I'm just going to do it again just for emphasis.
I didn't get to yet. No.
If you hover over Learn Options Education in there, this will take you to a place where we have articles, downloads. We have a box here for Options Replay. That's where all the recordings for this type of webinar are. And then we have additional webinars right here at the bottom. But if you go right here into the Options Replay, it'll open up this page. This video is the one we did last on Options Replay. The session today will be in here in this big box in about a few days, give or take. Once compliance approves the presentation, we're able to post it. But this is the one that we did last time. So make sure that you come here and explore all the different topics and strategies that Brandon has highlighted. But again, thank you again for everyone's time. Brandon, again, thank you for your time as well. And everyone have a great evening, and I hope to see you in one of our future events. Goodbye, everyone.